This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com. Last time, just to remind you, I said there are 4 questions in the exam, 25 marks each. And the various areas. Last time we covered most of management of working capital. Oh, Vita vaguely remembers the word. We covered all of investment appraisal, discounted cash flow, and whatever. And we dealt with sources of finance, which was mainly talking about different ways the company could raise money. So sorry, Andre, but we did. Yeah? If we run out of things to say today, maybe I'll say it again. But anyway, the 3 things we've got left. One is how we go about valuing shares. You know, I'm a small company. I'm not quoted on the stock exchange. If you were buying shares off me, how much would you pay for a share in my company? You with me? So how we go about what determines the value of shares and things. Sorry. Also, though, cost of capital, which is desperately important. The two actually fit together, as you'll see. And then slightly less important, it's not there every time, but it is due, in fact, foreign exchange risk, how we manage foreign exchange risk. But that's completely separate. We'll deal with that tomorrow. However, let's make a start. Again, last time we did most of the first 14 chapters. So I want to make a start on chapter 15, which is valuation of securities. So page 83. Say again? No, we didn't do 14. I said we did most of the first 14 chapters. Chapter 14, I did leave you to read, if you remember. Oh, yes. You've been reading it every night. There were only 2 pages. We will have a chat about it at some stage, but it was very brief, and they won't ask much. Anyway, chapter 15, valuation of securities. As I said a moment ago, what this is about is basically what determines the value of a share. You know, on the stock exchange, La Telecom shares might be valued at $4 a share today. They might be $5 a share tomorrow. But why? What fixes, if you like, the value of a share? All right? Now, in real life, there are all sorts of things might affect share prices, might affect how much you'd pay for a share in my company. In theory, though, and for any arithmetic you have, in theory, it's fixed by 2 things. The price you'll pay for a share, we say, is determined by the dividends you expect to receive and the rate of return that you require. So it's those 2 things, in theory, fix the amount you're prepared to pay. The expected future dividends and the required rate of return. Now, before I talk more about those, and incidentally, I should have said, I said last time, half the exam is writing. Most of what we do these 2 days is numbers. There's a lot of numbers to go through. But there is written that goes with it, so forgive me. I will have to talk at times. Because although the numbers, most of them are desperately easy, clearly you've got to understand why. You've got to be able to talk about them. Anyway, before I say any more about precisely what we mean by both of those, all I'm getting at is if you look at example 1, which is a real baby one, I need to build this up with a lot of little ones. It says here, Alpha has in issue $1 shares. So that's the nominal value. They've just paid a dividend of 20 cents a share. Dividends are expected to remain constant. So anybody buying this is expecting to receive 20 cents a share dividend. And for whatever reason, they require a return of 10% a year. Maybe they can get 10% putting money in the bank. They're only prepared to buy these shares, provided they're getting a 10% return on their investment. You with me? And so I don't think we need any formula or anything here. Surely, if you want to get a 10% return on your investment, if you expect to be receiving 20 cents a year, how much would you be prepared to invest, please? Say again? Oh, not 22. Hold on. You expect to receive 20 cents a year, in effect interest. You want that to be a 10% a year return. How much would you be prepared to invest? $2, surely. Surely, Vita, $2. If you put $2 in the bank, if you're getting a 10% return, that would be 20 cents per year. You agree? And all we've done is work backwards. We know, or we expect, we're getting 20 cents. We want that to be a 10% return. And therefore, you'd be prepared to invest $2. Does that make sense? Everybody? I say that's a baby one. Shortly we'll get a bit more interesting. And of course we need to talk about later where that 20 cents you expect might come from and why you want a 10% return. But for the moment, is everybody clear? If you're expecting 20 cents, if you want 10%, then, in theory, you'll pay $2. Okay? All right, well, I shouldn't need to ask, but still, I say we've got a lot of little examples to build it up. Can you do example 2, please? Example 2. This time they're 50-cent shares. We're expecting 15 cents a year receipt dividend. We require that to be a 12% a year return. How much would you pay for the share? Anybody got different? I don't think it's 0.9 either. Your turn, Ilse. 1.8. Maybe it's me. Hello, Ines. So what do you get? Oh, nothing. No, hey. Think about it. Make sure you get this straight. You said, what did you say? 1.8? No, you two said 1.8. Surely if you paid 1.8 for the share, we want a return of how much? 12%? If you were investing $1.80 in the bank, and it was giving 12% a year interest, how much would you be receiving each year? I think you'd be receiving 0.216 each year. Yeah? Well, we're not. We expect we're going to get 15 cents a year. 15 cents a year doesn't work. It's not $1.80. Vita, you said, was it 0.9? Yeah? If you put 90 cents in the bank, sorry, Ines, we're on page 84. If you put 90 cents in the bank, and the bank was paying 12% interest, well, a 12% a year return would be how much? 12% of 0.9, I think, would be 0.108. Well, we're not getting 108 a year. We're getting 15 cents. That's better, surely. I shouldn't need to use algebra. But if you put X dollars in the bank, if bank's paying interest of 12%, you'd be getting interest of 0.12 times X. we're getting a receipt of 15 cents. So I need to know how much are you prepared to invest such that the 15 cents a year you're getting is 12%. Are you all with me? And so surely the amount you'd need to invest would be 0.15 divided by 12%, or 0.12, which is, you'd got me worried earlier, I was right, $1.25. If you put $1.25 in the bank and the interest was 12%, you would get 15 cents a year. In theory, therefore, you'd be prepared to pay $1.25 for this share. All right? Now, Vita, you're looking very worried. Are we clear? I mean, the arithmetic's easy. The arithmetic itself is a joke, obviously. But are you all clear about the logic? The sense of it? OK, we'll do one more before I say any more, since we made a kind of complete disaster there. What's this one, please? Suppose I tell you, you expect to get a dividend of 30 cents per year. For whatever reason, you require a return you want the return to be, let's say, 18% per year. Well, to the nearest cent, how much would you be prepared to pay for that share? To the nearest cent, and in the exam you do it to the nearest cent. Andre thinks 167. Anybody think different? Good. I think we're right here. That surely the market value of the share, the price you're prepared to pay, same logic as before, for 30 cents a year to be an 18% return. To the nearest cent, it does come to $1.67. Do you all agree? Please, otherwise, or fellows are silly. Vita, look a bit happier. Does that make sense? Surely. All right, so that's all we're saying. In theory, the share price depends on the dividends you're expecting and the rate of return you require. And as I said, we'll talk later about why you might want 18%, why you might want 15% or whatever. But if I tell you it's 30 cents a year and it's 18% return, in theory, that is the share price. Okay? All right. One little thing which is very rarely relevant but just could be is what we're effectively saying there. Think about it. If you pay 167 for that share, you'll be getting back dividend, in a sense, interest of 30 cents a year. Well, it's like saying you pay out 167 now, and you expect to receive 30 cents in 1 year, 30 cents in 2 years, and so on. You would agree? That is the share price, assuming that by the share today, that the first dividend you're going to get is in 1 year's time. All right? Which effectively is assuming that this year's dividend has just been paid. So you buy it today, you won't get a dividend until 1 year away, 2 years away, etc. Well, in that situation, where effectively we're assuming they've just paid a dividend, we call it an ex-div share price. Ex-div means that they've just paid the current dividend. Again, we can learn rules, but I think you should see the sense of it. Again, if you put money in the bank, if you invest $1.67 at 18%, you'd be expecting interest each year, but 30 cents in 1 year, etc. All right? Well, he could just ask you, even though it's much less likely, he could ask you what's the share price if they were about to pay a dividend. Look at example 3. Beta has in issue 50-cent shares. They're about to pay a dividend of 15 cents a share. They're expected to remain constant, and shareholders' required rate of return is 12%. Now, it's exactly the same figures as in example 2. Example 2. We expected 15 cents a share, but they'd just paid the dividend. And in example 2, sorry, because we had that extra one I threw in, think back. Example 2, we said, 15 cents a share, 12% return. You've already got that written down, but the share price was $1.25. But that was the case when they've just paid a dividend. The first dividend you expect to receive is in 1 year's time. That was an ex-div share price. Agreed? Well, example 3 is exactly the same question. The only difference being, in example 3, if we buy the share today, they're about to pay the dividend, so you'll immediately get back a dividend of 15 cents, and then you'll get 15 cents a year. Everybody? Well, although I've typed a rule, which you may have read while I was talking, you shouldn't need one. Tell me, if you were offered exactly the same share, but in a sense you were buying it a day earlier, and therefore you pay for the share, you immediately get back 15 cents. How much would you pay for that share then? Yes, surely. If they were about to pay a dividend, you must shout if it doesn't make sense, but if they're about to pay a dividend, it's exactly the same share which we know is worth $1.25. But this time, you buy it, you immediately get back 15 cents. Surely, you'd be prepared to pay 15 cents more. And so if they're about to pay a dividend, again, the share was worth, if you like, $1.25. But add on the 15 cents you were going to get back. Does that make sense, everybody? It's $1.40. Well, if they're about to pay a dividend, we say the share price is cum div. And, although I think it would be awful to learn a formula, if this doesn't make sense, you must ask me. The cum div value is always the ex-div value plus the dividend about to be paid. Now, if you want to learn it, fine. It's not on the formula sheet. But again, I think that's something where it's more important you see the logic. And if you see the logic, then I don't really think there's anything to actually learn. Okay? Now, 2 things there. One is, before anybody shouts, I can ask you, what's the share price? If they've just paid a dividend, $1.25, or if they're about to pay a dividend, it's $1.40. Of course, it begs the question, what would the share price be if they paid a dividend 3 months ago, and so the next dividend is 9 months away? You understand me? Well, in the exam, he can't ask that. You'll see later we could deal with it, but he can't and he won't. Any time you're asked to value a share in the exam, always, they will either have just paid a dividend, ex-div, $1.25, or they'll be about to pay a dividend, cum-div, $1.40. Is that clear? Secondly, I have said it's rare this is mentioned. I have to mention it because he has mentioned it. It could be mentioned. But make a note that in the exam, whenever share prices are mentioned, whether it's this sort of exercise or you'll see things we do later, share prices in the exam are always ex-div unless you're told otherwise. So read carefully. If he specifically says it's cum div, or he specifically says they're about to pay a dividend, which means cum div. If he says that, you do it. If he doesn't say it, you assume it's ex-div. Is that clear? Okay? All right, let's carry on though. That's the basic idea, and I hope now it makes sense after that dreadful start we had. That the share price in theory is determined by the dividends you expect and the rate of return you require. However, what made those questions a bit too babyish was that we said we were expecting a constant dividend. When, of course, I think you'd agree, one of the reasons perhaps people buy shares is that you're more likely to be expecting that the dividends will increase in the future. Would you agree? I'm not saying that's a rule, but, you know, that's one of the reasons maybe you buy shares rather than put money in the bank. And of course, if I were to tell you, oh, I expect the dividend next year will be 20 cents, but the year after will be 22, the year after will be 25 or something, if I expect it's going to grow, then I think you'd agree life's not quite as easy. Well, we can write the rule more formally, and I've put in a box there, so I shouldn't need to write on the screen. On page 85 in that box, the more precise way of writing it, we say the share price does depend on the dividends we expect to receive and the rate of return we want. But we say it's the market value is the present value of future expected dividends, discounted at the shareholder's required rate of return. Now, forgive me, you three, for 1 second. Andre, have you ever heard of discounting? Because you weren't here last time. You've heard of it. All right, you'll see for the moment it doesn't matter too much, and we will, for other reasons, have some practice later. But what it does mean is, now don't copy this down because they won't do this in the exam. I'll tell you why in a minute. But I could say to you something like, I say don't copy this, but I could say you're going to buy a share. We expect next year a dividend of 20 cents. The year after we're expecting 25. The year after we're expecting 26. I mean, the point is I could write down any expectations I wanted. And if I said the required return is 10%, would you agree in theory you could go through and discount at 10% using your tables? Are we clear? Now, for reasons I'm coming to, you won't have to do that. But in theory, the share price always is the present value of future dividends discounted at required return. Okay? And perhaps a little bit of a waste of time here, but still, it only takes a second. Look at example 4. Again, the same question we did before, beta. They have in issue 50-cent shares. They've just paid a dividend of 15 cents. So it's ex-div. And here, despite what I said a minute ago, same example, the dividends are expected to remain constant. Well, although we know the answer earlier using a bit of common sense, what you could have done, surely, is you could say, what dividends do we expect? 15 cents a year. It's ex-div, so we first expect it in 1 year's time. We then expect it every year, presumably forever. You with me? So there are your expected dividends. The required return is 12%. And so strictly, the share price will be the present value discounted at 12%. Well, here's a tiny bit of revision of last time. If you've got a cash flow in perpetuity every year forever, tables don't work. Vita? Can anyone remember what's the discount factor for a perpetuity? Yes. If it's a perpetuity, which is very rare in the exam, the discount factor you multiply by 1 over R, where R is the rate of interest. Here it's 12%. 1 over 0.12. And of course, exactly as we got before, 15 divided by 0.12, I can't remember what we got. Yeah, 1.25 or $1.25. All right? Now here, I say, perhaps a bit of a waste of time. I mean, when it was a nice constant dividend, we ended up already happy using common sense, you know. But, strictly, it's the present value of future dividends discounted at required return. And again, in theory, you could cope with any dividend expectations. 15 next year, 16 the year after, etc. However, think about this. If I said to you, what dividends do you expect La Telecom is going to pay? You'd obviously, I think, look and see what they're paying at the moment, 15 cents, let's say. But I can't believe you'd tell me, oh, well, I think they'll pay 16 next year and 20 the year after and 19 the year... I mean, that would be ridiculous. I think, realistically, what you're going to say is, they've paid 15 this year. I think it'll grow in the future. I think it'll grow at, about 2% a year. Or about 10% a year. You're understanding me? That's more realistic, that you look at the company and say, I think it'll grow at 5%, 6%, whatever. I hardly think you're going to tell me it'll be 20 next year, 19 the year after, 18 the... You take my point? And so, the only situation you'll be asked to deal with is either a constant dividend, as we've been dealing with, or more likely, you'll be told expectations of constant growth. And to show you what I mean, can you turn to example 5?